Today, making sense of the senseless. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In our latest market update, we scan the markets as usual, and it seems to me finally the markets are beginning to wake up to the huge downside risks which are inherent in an overvalued inflation-driven, conflict-strewn environment. And it's worth remembering that many professional investors earn money facilitating the trades of other investors, so they still have a vested interest in talking the markets back or higher. For now, it seems to me there's no reason to think the dip is over, and by the way, many retail investors are starting to get twitchy. Indeed, Wall Street fell at the end of a volatile week on Friday as the war in Ukraine overshadowed an acceleration in US jobs growth last month that pointed to strength in the economy. Equities briefly rebounded from session lows in early trading after that stronger than forecast American jobs data, and the greenback rose to the highest level since 2020, and the Treasury 10-year yield slumped to 1.7%. So stocks did drop, while the dollar climbed with bonds as concerns that war risks are intensifying world markets around the globe. Commodities pushed higher amid fears of supply crunches heading toward their biggest weekly surge since the 1974 oil crisis. In fact, the S&P 500 traded off session lows as a rally in energy producers tempered declines in financial, tech and retail shares, and oil jumped at the end of the week, in which it swung by more than $20 a barrel. Europe's common currency approached a key support level that goes back to the euro's inception in 1999. The decline in the euro-US dollar pair has really accelerated over the past week after the West imposed severe sanctions against Russia that will have implications for the global economy and in particular Europe. The euro-US dollar was down 1.26% to 1.0925. Sanctions rarely work one way, but they are designed to ensure the maximum majority pain is imposed on the recipient country. Unfortunately for Europe, the recipient country is also an important trading partner and its main source of natural gas, among other things, which means pain at home is always inevitable, no matter how limited the impact was designed to be. Which makes trading in this pair so interesting. Not only is Europe feeling the pain this week, with equity markets on the verge of bear market territory, but the currency is also under pressure, particularly against a safe haven like the dollar. And by the way, 3 major Russia-focused ETFs were halted on Friday after the New York Stock Exchange took action based on what it said was regulatory concern. A top nuclear official called for talks with Russia and Ukraine after the government in Kyiv said Vladimir Putin's troops triggered a blaze at Europe's largest atomic power complex in a shelling attack. Economists at JP Morgan Chase said the war could hurt Russia's economy as much as its devastating 1998 default. But Federal Reserve Chair Jerome Powell said this week that he would support a 25 basis point interest rate increase at the central bank's March on the 15th and 16th, and would be prepared to move more aggressively later if inflation does not abate as fast as expected. Perhaps the biggest concern, however, is inflation, because both corn and wheat futures have had their strongest week in years, and crude futures are up another 3% after yesterday's pullback. All these price increases are affected by the Ukraine crisis, and anyone who believes the war is not affecting them is mistaken. WTI oil was up another 6.84% to 115.03. US wheat futures was up 6.7% to 1,210, and US corn futures was up 0.71% to 752.30. And the doozy, UK natural gas futures was up 26.53% to 485.92. US hiring boomed in February, showing a strong labour market that likely will keep the Federal Reserve on track to raise interest rates this month, while offering some respite from strong inflationary pressures. Non-farm payroll increased 678,000 last month. That's the most since July last year. And the unemployment rate edged down to 3.8%. and average hourly earnings were little changed from the prior month, missing expectations for a 0.5% monthly rise, despite numerous reports of companies having to hike wages to attract workers. The labour force participation rate, that's the share of the population that is working or looking for work, ticked up to 62.3%, and the rate for workers aged 25 to 54 rose to the highest since March 2020. While improved, a combination of factors like childcare challenges, COVID-19 concerns, and earlier retirements have whittled down America's workforce. Before the pandemic, the overall rate was over 1 percentage point higher. The flat average hourly earnings number was a relief to see, given the increasing inflationary worries, Eric Ditton, President and CEO of the Wealth Alliance, said. The market's focus is really not on payrolls, Jeffrey Rosenberg, a senior portfolio manager at BlackRock, said. The market is focused on the implications of the Russian invasion, and that implication is a negative supply shock, negative to growth, positive to inflation. 3 or 4 weeks ago, we would have thought that this was an incredibly important number, but given the backdrop and the overall events that are happening in Europe, it's just not, said Zachary Hill, head of portfolio management at Horizon Investments in Charlotte. The potential for escalation in the hot war, the potential for a growth impact in Europe and more broadly, and knock-on effects on the commodity channel and inflation are taking up all of the investors' time and energy, Hill said. It's not a surprise to see a stronger than expected jobs report in February as Omicron cases started to decline quickly, said Julian Koski, Chief Investment Officer at New Age Alpha. Because of the tragic events in Russia and Ukraine, global stocks are currently being priced based on uncertainty rather than known financial information, which is what traditionally has driven stocks. The tough part for the markets right now, and this is the reason we're not talking about the payrolls report, is that this commodity price pressure that was supposed to abate is not abating, Anastasia Amoroso, Chief Investment Strategist at iCapital, said. Fed Bank of Chicago President Charles Evans said the central bank should increase interest rates to close to its neutral setting this year, implying as many as 7 quarter-point hikes. And meanwhile, former Treasury Secretary Lawrence Summers warned that the war in Ukraine and the legacy of Washington pumping too much stimulus last year means an increasing danger of stagflation for the US economy. And it's worth noting, by the way, that the unemployment rate dropping to 3.8% was a blowout number, and it helps to smooth out some of the inconsistencies or disappointments of recent reports from December and January. But for the Fed, while this is an interesting data point, if Chairman Jerome Powell was going before Congress today, I don't think he'd say anything different from what he said earlier this week. Right now, the situation in Ukraine overshadows everything, and what happens in Ukraine will likely have greater impact on the markets in the short term than what the Fed does, although the Fed's actions will, of course, have a long-term impact throughout the year. However, if the Ukraine situation did not exist, this report, along with the rise in commodity prices, would be putting even more pressure on the Fed to raise rates faster. If you take a close look at the report, by the way, the only head-scratcher that jumps out is the average hourly earnings being 0 month over month. Now, that's possible that it could be attributed to a lift in leisure and business services, for example, bars, where employees rely heavily on tips, or retail jobs that tend to be lower paying, but it's still somewhat confounding. The S&P 500 fell 0.8%. The Dow Jones Industrial Average fell 0.5%, and the Nasdaq Composite fell 1.7%. In fact, most of the 11 major S&P sector indices declined, with financials falling the most, with a loss of 2.6%. And the bank index fell 4.2%, extending its loss for the week to about 9%, as investors worry about how the West's sanctions against Moscow will affect the international financial system. Amazon, Apple, Google, and Microsoft all slipped more than 1%, and Nvidia Corp tumbled 4.4%. The crisis in Ukraine boosted energy stocks as crude prices rallied on the back of Western sanctions against Russia, a major oil producer. And the S&P 500 energy sector gained 1.4% and looked to set the week with a rise of around 8%. Richly valued growth stocks have faced the brunt of the sell-off so far this week, with the S&P 500 Growth Index down about 2%. Its value counterpart has recorded a smaller fall of 0.9% thanks to support from soaring energy shares. Soaring commodity prices spurred by sanctions against Russia have raised fears of even greater inflation, which could prompt the Fed to hike interest rates more aggressively. And the volatile index, also known as Wall Street's fear gauge, rose 4.92% to 31.98. Of course, in the fog of war, truth fades. Russia said it would block Facebook for blocking state media, and Britain's BBC stopping reporting in the country in the face of a new media law, as Moscow on Friday raised the stakes for foreign corporations over its attacks on Ukraine. Internet provider Cogent said it would terminate services to Russia, potentially deepening the country's isolation. Microsoft said it was suspending sales in Russia, and video game maker Electronic Arts, which had removed Russian teams from popular games, said it was stopping sales of games in Russia and Belarus. Russia said that Meta Platforms' Facebook was to be blocked for restricting state-backed channels, and it also blocked websites of the BBC, Deutsche Welle, and Voice of America for what it said was false information about the war in Ukraine. The BBC said it would temporarily suspend its work in Russia after the introduction of a new law that could jail anyone found to be intentionally spreading, quotes, fake news. The actions by Moscow came after a week of censure by major global brands for the attack on Ukraine. Shipping and supply chain issues have made it difficult to work in Russia as well. Companies from Shell to Apple to Toyota have taken actions from stopping sales and operations to exiting completely. Moscow actually laid out options for foreign companies on Friday: stay in the country, exit entirely, or hand over their holdings to local managers until they return. Now, none of those routes comes without risk. Those staying could face a backlash in Western markets where the public have rallied to Ukraine's cause. Those transferring shares could be handing over the keys with few guarantees, while those quitting may face a big loss at best, or might have to sell for a nominal sum. It's a complicated process, said Darren Woods, chief executive of US energy giant ExxonMobil, which is exiting oil and gas investments that involve partnerships with Russia's Rosneft and others worth $4 billion. Russia's invasion, which Moscow calls a special operation, prompted the United States and Europe to impose swift and sweeping sanctions affecting everything from global payment systems to a range of high-tech products. Western companies probably haven't lost so much money so quickly due to geopolitics since the Shah was overthrown in Iran, said Renaissance Capital chief economist Charlie Robertson, referring to the Islamic Revolution more than 4 decades ago that led to an exodus of Western businesses. Yet some companies do plan to keep going. Italian tyre maker Pirelli said it set up a crisis committee to monitor developments but did not expect to halt production at either of its 2 Russian plants. Its rival, Finland's Nokian Tyres, said last week it would be shifting production of some product lines out of Russia. But there are no easy fixes, even for those looking for an exit, when there are limited trading counterparties. British insurer and asset manager Royal London said it planned to sell its Russian assets, which it said only accounted for about 0.1% of its portfolio. We can't trade these things anyway, but as soon as we can, we obviously intend to divest, Chief Executive Barry O'Dwyer said. For companies packing up, the Russian First Deputy Prime Minister said a fast-track bankruptcy plan will support the employment and social well-being of citizens so that bona fide entrepreneurs can ensure the effective functioning of businesses. So far, global companies, banks and investors have announced that they have exposure in some form to Russia of more than $110 billion. That number could rise. Data from research firm Morningstar shows exposure from international funds to the tune of $60 billion in stocks and bonds. BASF, the world's largest chemicals group, said it was halting new business in Russia and Belarus, except for food production for humanitarian causes, and also hinted at the minefield of new rules sanctions have introduced. BASF will only conduct business in Russia and Belarus that fulfills existing obligations in accordance with applicable laws, regulations and international rules, it said. Swiss food giant Nestlé, maker of Kit Kat bars and Nescafé coffee, said it was halting advertising in Russia, while Swiss watchmaker Swatch Group said it would continue its operations in Russia but would put exports on hold. Deutsche Bank said it had been stress testing its operations given it has a big technology centre in Russia, but was assured it could run its everyday business globally. The German lender had opened a new office in Moscow in December, a move it said at the time represented a significant investment and commitment to the Russian market. Now over in London, the FTSE was down 3.48% to 6,987. That's a significant fall. While the DAX in Germany was down 4.41% to 13,094, and the French CAC 40 fell 4.97% to 6,061. In Asia, the Shanghai slipped 0.96% to 3,447. The Hong Kong Hang Seng dropped 2.5% to 21,905. And the Nikkei 225 slipped 2.23% to 25,985. Much of this weakness is because of the ongoing situation in Ukraine, the most recent concern being the Russian attack on the nuclear power plant, which resulted in a fire. Fortunately, that fire is now extinguished, but the Russians are in control of the facility. And while the head of the International Atomic Energy Agency stated there was no release of radioactive material, investors are still bearish given the overall situation in the war zone. Now, down here in Australia, Australian shares ended a 5-day winning streak in dramatic fashion on Friday, with regional markets sliding sharply on reports of that fire at the nuclear plant. The S&P ASX 200 closed 0.6% or 40 points lower at 7,110, and the All Ordinaries dropped 0.7% to 7,395. Oil extended its rally alongside other commodities, which contributed to the local market posting a gain for the week of 1.6%. But the ASX energy giants paused their March rally, with Woodside Petroleum up only 0.3% to $31.42 and Santos dipping 1% to $7.76. BHP Group edged 0.2% lower to $49.94 and Rio Tinto fell 1% to $126.56. The Australian market took a weak lead from Wall Street, and the local market's losses accelerated to 1.8% mid-session as news broke about the situation at the nuclear plant. The reaction in currency markets boosted the US dollar, and that unseated the Australian dollar from its 4-year month high of $73.48, and in fixed income it slashed 7 basis points off the US 10-year Treasury yield. The technology sector was hit the hardest by the flight to safety on Friday, led by a 9.2% fall by Afterpay parent Block to $152.95. EML payments dropped 6% to $2.37, and Tyro payments dropped 5.4% to $1.59. Gold miners rallied as the spot price of the precious metal rose in investors' broad flight to safety. Newcrest Mining advanced 2.8% to $26.02, Perseus Mining rose 3.1% to $182, and Gold Road Resources gained 2.6% to $1.59. Outside the benchmark, Kingsgate Consolidated surged 27% to $149 after securing funding to restart its Treasury mine located in Thailand. Energy stocks fell 1.1%, even as oil prices extended gains. The United States and Iran could soon agree on a nuclear deal that would ease supply shortage concerns. Santos dipped 1% to $7.76, but Woodside edged up 0.3% to $31.42. Amongst financial shares, Zip was the biggest laggard, off 8% to $1.72. CBA was the only major bank which eked out a gain, just up 0.1%. Magellan plummeted 3.25% to $15.48, and Pendle shed 2.3% to $4.33. The consumer staples sector outperformed, up 1.2%, with Woolworths, Bega Cheese and Coles leading the charge. Woolworths jumped 2% to $34.81, Bega gained 1.7% to $4.73, and Coles was up 1.2% to $17.18. Now in crypto land, Bitcoin hit lows of $39,083 after the largest cryptocurrency by market capitalization had been steadily declining since March the 2nd, presumably due to fears that the Federal Reserve might tighten monetary conditions quickly in the face of rapidly growing inflation. Altcoins likewise fell as the cryptocurrency market tumbled under selling pressure. The Crypto Fear and Greed Index that gauges market sentiment measured fear, and according to recent data from CoinGlass, 69,314 traders were hit with liquidations as the entire crypto market dipped. Over $271 million was liquidated in the last 24 hours, with roughly $102 million occurring in the last 4 hours, and nearly $180 million of that was tied to Bitcoin trading positions. On the Bybit exchange, the biggest single liquidation order was placed. Bitcoin trades at around 39,200 at the moment. Gold, on the other hand, had its biggest week in almost 2 years, inching towards the long-eyed $2,000 an ounce, as worsening Russian aggression in Ukraine raised geopolitical risks that boosted the yellow metal. For the week, the benchmark gold futures rose 4.2% for its largest weekly advance since July 2020, when it was en route to record highs above $2,100 in August that year. Since achieving that pinnacle, gold has fallen to $1,600 and risen to as high as $1,976 last week without being able to test the $2,000 target. But the Russian invasion of Ukraine and soaring inflation in the US could, however, change the fortune of gold longs. Gold has key technical resistance levels it has to break past, but the argument for the $2,000 level does not seem so far-fetched anymore, said Ed Moyer at online trading platform Onya. Demand for safe havens was elevated after Russians seized Europe's largest nuclear plant. And that was leading to fears that they have an ambition to take control of all of Ukraine. With both European equities and the euro in freefall, demand for safe havens will not be easing anytime soon. Gold, standing as an inflation hedge, has also been greatly boosted by the growth in US prices due to ultra-low interest rates and trillions of dollars of pandemic-related spending. But inflation grew even more. The Personal Consumption Expenditure Index, a US inflation indicator closely followed by the Fed, rose to 5.8% in the year to December and 6.1% in the 12 months to January. Both readings also indicated the fastest growth since 1982. The Fed's own tolerance for inflation is a mere 2% per year. Inflows into exchange-traded funds on the back of the war in Europe and the economic fallout may also provide a pillar of support for bullion prices, according to Bloomberg. Holders in gold-backed ETFs could increase by 600 tons this year if concerns over US growth widen, potentially leading to a price spike to $2,350 an ounce, according to Goldman Sachs, who always tend to be very bullish. Inflows into the funds have totaled just about 100 tons so far, said Bloomberg. So, what do we make of all this? Given the Dow has fallen 4 straight weeks, the VIX is near 32, recession signals are surfacing, and war in Europe is dousing sentiment. With trouble everywhere, getting a handle on who's doing what in the stock market is hard, but one overarching trend took shape this week as the S&P 500 slid in 4 of 5 days. Professional traders, while keeping a hand in for stock picking, took a broad step back, while individual investors kept the money flowing. Evidence comes in a report from Goldman Sachs Prime Brokerage, which found that over 3 days, hedge fund clients unwound risk at the fastest rate in 3 months in cumulative dollar terms. At the same time, flows tracked by JP Morgan Chase showed retail traders bought $4.1 billion in the week through to Tuesday, with money sent to the S&P 500 linked ETFs more than 2 standard deviations above the 12-month average. Views on the markets always diverge, of course, but are doing so now in a particularly violent way, with war, Federal Reserve hawkishness and uncertain economic prospects challenging convictions. UBS Group published a scenario analysis citing a machine learning model that reckons the Russia-Ukraine conflict could send the S&P 500 anywhere from 3,800 to 4,800. That's a 26% range, depending on how it resolves. The outlook remains very uncertain and more difficult to predict than even during the COVID crisis, said Seema Shah, Chief Global Strategist at Principal Global Investors. Many investors are taking a long view of the market, particularly for the US, where economic implications of the conflict are expected to be relatively contained, she said. On the other hand, geopolitical risk is extremely high. Declines on Thursday and Friday erased the S&P 500 gains from the previous week as Ukraine said Russia forces attacked a nuclear power plant, sparking a surge in oil prices and a rush for haven assets like gold. Volatility has been the only constant since January the 31st. The S&P 500 has posted 13 daily moves of at least 1%, 6 up and 7 down. And the volatility index, the gauge of options cost tied to the equity benchmark, has averaged almost 25 this year and closed the last 5 days above 30. At this rate, 2022 is shaping up as the second wildest year in the past decade, behind only the pandemic year of 2020. Amid heightened macroeconomic uncertainty, trepidation is building among pros. Hedge funds, which cut their equity exposure to the lowest level in almost 2 years in February, kept trimming into the new month. On Wednesday, when the S&P 500 rallied almost 2%, clients tracked by Goldman Sachs cut long positions and covered shorts. And the caution was echoed by a poll from the National Association of Active Investment Managers, where an index of their stock exposure fell this week to levels last hit in the intermediate aftermath of the pandemic bear market. Pessimism is swirling as harrowing headlines emanate from the Ukraine war, and odds grow that surging commodity prices will slow global growth at a time when the Fed is poised to hike interest rates this month. Haven assets like Treasury bonds were sought, while measures of funding stress spiked. A study by Luca Paolini, chief strategist at Pictet Asset Management, showed that every 50% oil deviation above its long-term trend line, as is the case now, has led to an economic contraction since 1970. Every other market is consistent with the idea that the economy is in trouble and there's stress in the markets, said Jim Bianco, president of Bianco Research in Chicago. The stock market historically does this. It's the last market to turn. It's the slowest market to understand the problems. It's the market driven by narratives and hope. But you can count retail investors still among the optimists. The crowd has purchased a net $36 billion of equities so far in 2022. That's the most at this point on the calendar in the last 5 years. That's according to JP Morgan data. For all the uncertainties, the bull case still has been hard to dismiss by some. Solid economic growth is expected through the year and next, and so are earnings for corporate America. And while the raging war hurts investor appetite for European equities, at some level, it's actually helped the America First trade. The average stock on the S&P 500 has seen its price-earnings ratio drop slightly below the 10-year average. That, along with falling Treasury yields, points to favourable valuations for equities. Moreover, history shows the market impact from military events was often fleeting. But of course, we don't know how long this is going to run on, and there are still many twists and turns ahead. So I'm certainly not on the side of piling in now. I think we should watch and wait. But of course, there will be some that will try to see the buying opportunity amidst all the noise. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.